In our earlier technique of risk adjusted discount rate, we were adjusting risk in the discount rate. Now, just think for yourself. Is the risk for the cash flow or is it the risk for the discount rate? See, if you will ask this genuine question, you will realize the limitation of the earlier technique. In earlier technique, we were arguing that, see, this project has higher risk, so I will demand a higher risk premium, because of which your discount rate will be a higher discount rate. And then the cash flows were discounted at a higher rate. Apparently, it seems to be all okay. But see, risk is with respect to the cash flow. I have projected certain cash flow for my project. Someone is asking me, are you 100% sure that you will get this cash flow? I am not 100% sure. Because I am a little bit uncertain, there is risk. Now tell me, is the risk for the cash flow or is it the risk for the discount rate? You are adjusting discount rate at the wrong place. You should be adjusting the discount rate in the cash flow. That is what we do in the CE approach. In the CE approach, we are adjusting the risk not with the discount rate but with the cash flow. For example, let us say I'm planning to do certain project, and let us say in year 1 I have projected that there shall be a cash inflow of rupees 1 lakh. Okay, I have projected that the cash inflow of rupees 1 lakh. Now someone is asking me, are you 100% sure? Do you have 100% guarantee that there will be a cash inflow of 1 lakh? I am not 100% sure that there will be a cash inflow of 1 lakh. That does not mean that you are not having certainty with respect to any portion of the cash flow. Now, when I projected this rupees 1 lakh, I have on hold a government project. I have already signed a government project. And from this government project, I am going to get 70,000 rupees. So when someone is asking me, are you 100% sure for 1 lakh? I am not 100% sure for 1 lakh, but I am 100% sure for 70,000 rupees. 70,000 rupees is going to be generated from a project which I have already entered into with the government. I've already signed that contract. Maybe I've already received the advance money. So there is a certain level of certainty with respect to the cash flow. I am uncertain not for the entire 1 lakh. See, I'm making a very important statement. You have projected a cash inflow of rupees 1 lakh. I am not certain about, I am not uncertain about entire 1 lakh. I am uncertain only with respect to 30,000. You getting me? I have projected 1 lakh rupees. Out of that 70,000, in any case, I am going to get. So risk is not for entire 1 lakh. Risk is for only 30,000. What we were doing in risk adjusted discount rate is we were increasing the discount rate and then discounting entire 1 lakh at the higher rate. Well, the fact of the matter is that risk is not for entire 1 lakh. Risk is only for this extra 30,000. 70,000 I will get from the government project. I am a little bit doubtful, I'm a little bit apprehensive whether I will get the remaining 30,000 rupees or not. In other words, out of 1 lakh, 70,000 is certain. That is what we call as the certainty equivalent approach, right? We are calling this as the certainty equivalent approach. The way we do this approach is we calculate what we will refer as a CE factor. CE factor is certain cash flow divided by total cash flow. In our example, we are certain about 70,000 out of 1 lakh. That means my CE factor is 0.7. So how to do analysis in this particular approach, right? The way I will do analysis in this approach, for example, in year 1, first I will take the entire cash flow, which is 1 lakh. Then I will apply the CE factor, which is 0.7. and then I will multiply the two. As I multiply the two, I will get the certain cash flow. So the moment I multiply the two, I get certain cash flow, which is 70,000. Because this cash flow is certain, it is 100% guaranteed. And because it is guaranteed, there is no risk. And because there is no risk, you will discount 70,000 at the risk-free return. You have to just ask yourself that if you are not taking any risk at all, then how much return will you get? At that risk-free rate of return, you should carry out the discounting. This is a far superior approach compared to the risk-adjusted discount rate technique. We see the write-up with respect to the same, right? They are saying the certainty equivalent is a guaranteed return that the management would accept. As I was saying, out of the entire cash flow of rupees 1,70,000 is certain. So as a management, I will do analysis on the basis of 70,000. I just ask myself that, okay, forget about that extra 30,000, which we may or may not get. 70,000 in any case, I am going to get. So using the guaranteed cash flow, I will carry out my entire analysis. So that is what I'll be doing here. What are the advantages? It is simple and easy to understand. Yes, it's really simple and easy to understand. And it can also be calculated for different risk levels. But that does not mean it does not have certain disadvantages. It does have disadvantages. And the main disadvantage is developing the CE factor. Out of a total cash flow, how much is certain? It is not that easy to determine. So that's the limitation of this particular approach. And perceiving risk is very what you can say, very objective. The way I will perceive risk, not necessarily you will perceive the risk. So the risk perception can be different, and then everything is depending upon the risk perception of the management. What about the risk perception of the shareholders? Ultimately, it is the shareholder who has invested in the shares of a particular company. But then we know that in a company, decisions are not taken by shareholder, but decisions are taken by the management. So the risk perception of the management may not necessarily match with the risk perception of the shareholders. So developing objective CE factor is actually very tough in the real life.